2024 has not been the greatest year for REITs. As we can see, the majority of them are in fact down year to date, and more bad news seems to be on the way. We have a very likely scenario now where the Fed will not cut rates this year, which has really hampered the growth of Realty Income. And to make things worse for them, Walgreens are likely to close 150 of their stores in 2024. And if you remember from a previous video where we discussed Family Dollar and Dollar Tree to close 1,000 stores. Now, the reason why this impacts Realty Income, as we can see in terms of their top 20 clients, their top 3 alone are Dollar General, Walgreens, and Dollar Tree from the Family Dollar. So it doesn't really help Realty Income moving forwards. And in today's episode, we are going to take a deep dive of this company, take a new look. In fact, we can see a triple buy rating, Seeking Alpha, Wall Street, and Quant. In fact, we also have a near 6% forward-looking yield for the monthly dividend-paying company, and we want to analyze whether or not now is a good opportunity to buy Realty Income or add more if this is one you already hold. Now, we're also going to take a look at some of the supplementary information in case you missed it from their latest earnings, and we also want to take a look at some slides from their investor presentation just to refresh your memory, but also take a look at the European sector, which is one area that Realty Income are looking to grow moving forwards. We're also going to touch upon their dividend safety, some of the supporting underlying metrics that are relevant to real estate investment trusts, like their adjusted funds from operation, as well as their debt levels. And we also want to talk about some insider selling that we have seen just over the last few weeks, and also talk about both insider buys as well as what the larger institutions have been doing on a more quarter-to-quarter basis. On top of that, which is involved in our deeper dive, we'll remind you of the growth that Realty Income has seen on both their top line as well as their bottom line, and also look towards the health of this company, their total cash versus their total debt, which will come in handy when we do look at the dividend safety. And ultimately, we want to run this REIT into our valuation model, getting to both our intrinsic value, our acceptable buy price, given our investor margin of safety, and look towards Wall Street, see what they're forecasting for this company over the next 12 months to consider whether Realty Income is a buy, hold, or even a sell. Now, the first thing that we do want to take a look at is just the performance. Now, we did note a triple buy rating, which is nice to see. This company does currently trade in the mid to lower end of the 52-week range. A nice monthly yield, as we can see, around 6%, and on a P to FFO around 12.53. Now, as we said, REITs have had no love over the last year. They are down around 11%. But in actual fact, if you've been an investor over the last 5 years of Realty Income, you would be down around 22%. Bear in mind, if you do reinvest those monthly dividends, you would have a slightly better performance. And over the last 10 years, you would be up only 22%. So not the greatest over the longer term. So let's find out if this is one that we can continue to invest in for long-term growth, not just on dividends, but also the share price return. Now, what we'll take a very quick reminder of the growth of REITs, we do want 5 to 10% year on year. And we can see with Realty Income, very nice growth. 934 million on the top line in 2014. We can see more than 4 times 4.1 in the more recent year. On a trailing 12-month basis as well, we can see the growth looking to continue, and graphically we can see very nice, it is increasing over the last 10 years. In terms of the bottom line, we also do note the growth there as well, 271 million 872 in 2023, and as we can see, maybe not as consistent as the top line growth, but over the longer period it is increasing, although we do want to point out over the last year it has remained fairly flat, and we would like to see how essentially the acquisition of Spirit Realty does affect their top line as well as their bottom line into the full year of 2024. Now, when we take a look at the health of this company, why we always talk about that is just for the security of that dividend from this monthly payer. 4 million of cash in essentially 2014, 680 million from their latest quarterly report. We can see very inconsistent, and in reality, this number doesn't mean anything on its own, which is why we always couple our analysis on the balance sheet with the total debt, numerically and directionally, going from around 5 billion to around 26 billion, so more than 5 times growth of the total debt, and we can see it is increasing over the longer term. In isolation, this isn't a red flag indicator. It is something we commonly see with REITs. They do essentially have a large debt position year on year as they continue to grow. But again, something we do need to consider when we do look at this monthly payer very soon. Now, as always, we want to see how they've performed on an FFO, funds from operation, as opposed to an EPS, earnings per share, that we look for other companies in terms of their performance. And what we can in fact see, fairly mixed. They did miss over the last 2 quarters, as we can see, and the 2 prior, they at least were in line or a beat. So overall, a 50% track record, and the growth moving forwards, as we can see, the next 2 quarters, low single digit increase. Quarter 4, as we can see, high single digit, and quarter 1 2025 double digit growth on a year-on-year comparison. Now, if you know this REIT, you know the growth isn't going to be tremendous, and as we can see here, 4.23 on an FFO for the full year of 24. 4.37 for the full year of 2025. So overall 50% track record, and the growth, it doesn't look too bad, probably expected for a REIT of this size and nature. And when we take a look at the first grade, it is the valuation for Realty Income. They do get a B-. Now, the main thing to take away from REITs, what we want to focus our attention on, is the P to AFFO, price to the adjusted funds from operation, as we can see here if you want to take a look at what this is for. What they get is a 12.71, and as we can see, this is lower than the sector median of 14.64, so you are getting at a discount to the sector, 13%. Whether or not you believe it is a better company or better REIT within the sector, we can see it does trade lower than the average. There are other metrics here if you do want to include, but for REITs, that is essentially the most relevant one. We then move on to the growth grade, where they get an A+. Again, one thing we like to touch upon is the adjusted funds from operation growth. Over the last 5 years, in fact, even over the last 3 years, they're a lot better than the sector median. If you want to look forwards as well, 3.25, with others around 1.61. Other methods here as well, we will cover a lot of these later on, especially focusing on the dividend growth as well as the dividend payout. But you can see for this sector, they do ultimately get essentially an A+ rating. We then move on to the final one, which is the profitability grade. They get an A. Again, if you do want to take a look at essentially some of these metrics, most important ones we will cover, but we can see, for example, the AFFO in terms of their total revenue, 87%, A+, a lot better than the sector of 40.5%, and their cash from operations, we're talking about the billions, whereas others around the millions, 229 to be exact. So for this part of our analysis, just to conclude, a triple buy rating from the analysts, a B- on valuation, an A+ on growth, and an A on the profitability. So overall, it is looking good as we continue. We then take a look at how they've performed against others. Now, the REIT industry as a whole hasn't performed great lately. We see retail REITs, Simon Property Group, Kimco Realty, a few of these other ones that we have covered. And what we do notice, Realty Income, the worst performing, -6%, and that is even after reinvesting those lovely, essentially monthly dividends we like with this company. Over the last 5 years, again, down -2%. If you've been a long-term shareholder and you have been reinvesting, around 95%, the best performing, but that is over the longer period. Whether or not that is good for you, just remember that the past performance of any of these REITs or any companies we look at is no indicator to how they'll perform in the future. Now, in terms of insider ownership, 0.1%, we do notice one incident of insider selling over the last 12 months, $471,000. And in Q2, we can in fact see 271,000. So it must be the sale from the same person, as we see the director. More recently, 9th of April, he did sell 5,000 shares, $54, so slightly higher than the current trading price, 271,000. We wouldn't really say this is a bearish signal. Pretty much, if it was a buy, you could argue a bullish signal, as they buy because they believe the share price will go up. With sales and insiders, there is no real understanding, whether it's personal or financial, we don't really know. Plus, you could argue a trivial amount. So let's continue, but the information is there if you want to use it. Institutional ownership, 71%, 1.2 billion worth of sales over the last 12 months. We see a lot more buying by the institutions over the same period, and the same can be said in quarter one, a massive amount more of buys, 1.8 billion versus 300 million, and the same can be said for pretty much every single quarter over the last few years. So do understand, even though institutions have been buying a lot more, always do your own due diligence, never copy what these larger corporations do. Now, very, very quickly, From the supplemental information from that investor presentation they released a few weeks ago, we just want to highlight more for those that are new to Realty Income that even though the interest rates may essentially not be cut into 2024 and the beginning of 2025, it's important to understand two things. The thing to note here that we want to highlight is that their variable debt at $1.5 billion is only 5.8% of their total debt. As we can see, the majority of their debt is in fact fixed, 94.2%, and it's fixed for nearly 6 years. So realistically, if you believe interest rates might not even be cut for another 2 years, you can see that Realty Income have nearly 6 years before they need to refinance this debt, which currently sits at 3.88%. So as we always say on these reviews, with essentially the debt, the interest rates for Realty Income, we don't believe it to be a massive issue unless you believe that over the next few years, the interest rate will either continue to stay as it is or in fact increase over the longer period. We then move on to the investor presentation. Again, this is more focusing on some of the aspects that maybe you're not too sure of. First one here is the client diversification. We did touch upon this right at the beginning of the episode, and as we can see, their top 20 clients, in fact the first three, Dollar General, Walgreens and Dollar Tree, all currently have issues. And one of the things that we want to highlight in today's episode is, as you can see in the geographical diversification, that essentially Realty Income's tenants aren't just based in the US, if that is what you were understanding to begin with. We also have the industry diversification as well. Different sectors, we have grocery, we have home improvement, we have drugstores, restaurants, we have automotive, health and fitness. So it isn't just in the groceries, which maybe if you were to read the news, you might be under the impression that Realty Income just has essentially Walgreens, Dollar General as their largest and main customers. So the first thing we want to show you is essentially that there is a lot of opportunity for Realty Income in Europe, as they can see here. They believe there is an 8.5 trillion TAM, which is a total addressable market in Europe, and they already see their existing account for over 75% of this market, so that is very positive to note. And in particular, for those that did miss it, they did partner with one of the, as we see here, the largest European retailers, Decathlon, and this now makes up 1% of all of their rent, which is very strong, especially forward looking. We can also see that the investment essentially into Europe continues quarter on quarter. We have essentially some where it is larger than others, but overall this is something that they're really keen on expanding within their home business. We then take a look at quickly at some of their portfolio, more for the European investors who do know a lot of these companies. We have B&Q, Asda, Sainsbury's, Carrefour. In fact, as we can see here, Carrefour, the second largest grocer in Spain, and both Tesco and Sainsbury's, the top grocers in the UK. So it does look very positive if this is one area that they can continue to capitalize on. So we can see that adjusted funds from operation growth going from more the lower end of the low single digits to the mid to high single digits year on year. Again, just to point out that 10% of their annualized rent does come from grocery stores, and they have captured a large market in both the US, where as we can see, the top US grocery clients do control 35% or more of the market, as well as the UK, the top two, as we mentioned, over 43% of that market share as well. Finally, we just want to move on to essentially the forward guidance, and only really one thing that we want to point out here is the occupancy rate. The rest, yes, they are important and we will cover them in some way, but the occupancy rate that you want to see ideally is around 100%. What we can see though for Realty Income, it does always tend to be high, around 99%, at least for the full year of 2024, they're looking at over 98%. So no worries. Yes, we did speak at the beginning of the closures of Walgreens as well as Family Dollar, but we don't see over the longer term how this will impact Realty Income. But as always, let us know your thoughts in the comments below. Now, when we take a look at the dividend safety, we just want to let you know we have released our latest free weekly article. We cover essentially strong recession-proof stocks if you believe one is incoming. We also look at 20 undervalued stocks to consider for your own portfolio, and other articles, all completely free. Click on the pinned comment below. You can sign up and read straight away, as well as how to find undervalued stocks, where we run through essentially all the websites and resources that we use both on the channel as well to identify companies to buy. So a dividend safety score of 80, it does look to be safe. Market cap 46 billion, is a large cap company, and as we mentioned, a near 6% yield, as we can see, 5.94. So we then move on to look at the dividend safety. It was reaffirmed just a few weeks ago that essentially a dividend cut does look to be unlikely for this company. No surprises so far, but let's dig deeper into the information. This is the last recession, 07-09. They increased the dividend. They had essentially flat sales So this was above the average of the S&P at negative 0.8 versus negative 12, and they also outperformed the S&P negative 43 when the S&P returned negative 55. Now in terms of dividend growth, the main thing that we always like to highlight on the channel is you want to be aiming for 4% or more, whether that's your dividend increase, your salary increase, or even your other income producing assets. Reason for this, US inflation over the last 40 years was 4%. If you are getting less than that, you are effectively taking a pay cut or losing your purchasing power. With Realty Income, over the last 4 years and the last 5 years, it is near enough that 4%. Over the last 20, it is marginally higher, but definitely something just to think about throughout this episode as well as your investment journey. In terms of dividend years increases, 29 years, so they are officially a dividend aristocrat, which is a company that has increased it for 25 or more, and they have paid a dividend for the last 55 without a reduction. Now, for those that are new, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. We have a severe undervaluation signal here, and on the forward P to AFFO, 12.6 versus the average 5-year rolling of 17.6, and a triple undervaluation signal as it is much lower than the real estate sector of 14.1. Just bear in mind, we're not looking at any one of these models in isolation, and we will conclude shortly as well. Free cash flow payout, if you're a regular viewer, you know we focus on this, but for REITs, it is a lot more volatile, so we draw your attention to the adjusted funds from operation payout, below 90% and absolutely no worries here, not only decreasing, but 76 in the more recent year, 75 anticipated next year, so we can already see why that dividend does look to be safe. Adjusted funds from operation per share, we want to see consistent increases over the longer term, as we can see here. $4 in 2023, anticipated to go up higher again, continue that trend into 2024, so always a good sign. And on the left, we can see the percentage increases, low single digit 2% in 2023. Nice to note this is expected to increase to 4% in 2024. Ideally soon, we want to see the effects of that acquisition of Spirit Realty incorporate into these numbers and see some slightly higher numbers than what we have historically seen. In terms of the sales growth that we analyzed earlier, 5 to 10%, pretty much at a minimum over the course of the last 10 years. Last 3 years looking very strong. On a trailing 12-month basis, 27% is also looking good. Total sales numerically, then we can see what we just analyzed earlier. And always remember that with REITs, very typical that they do dilute your position over the longer term. Some quicker than others. Realty Income, as we've said many times, is a company, or a REIT we should say, that does dilute your position at a very rapid rate. But as long as the AFFO is continuing to increase, then this isn't a massive issue, but something just to keep an eye on. ROIC then, return on invested capital, we want to see at a minimum around 3 to 5%, which it does hit it over the longer term. Reason for this is it does give us faith that the management team are able to effectively allocate their capital, and we can see that although it was 4% consistently, even after the drop to 2%, it has come up to 3%, so let's hope that they can go back up to 4% as a minimum. Finally, the operating margin, whilst we want to see increasing margins over the longer term, we have noted a drop from 2020 down, something again we can keep our eye on. 43% in the more recent year is still looking very solid, but it would be nice to go back up to the high levels we saw in 2014 to 2015. We then move on to the final net debt to EBITDA. Now remember, this correlates to both balance sheet strength and dividend safety. It is the earnings before the interest, tax, depreciation, amortization. Below 5.5 is what we want to see for REITs, and remember, these are the number of years it would take the company to pay off all of that debt net of cash on hand. Pretty high over the more recent years, 22, 23 in the 6 level. Nice to note, forward looking, going down to 5.27, below the 5.5 maximum, and probably in conjunction with the payout ratio around 75%, why we see that dividend safety score at 80, but something just to keep an eye on. So as always, let's now jump into the valuation model. If value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Let's jump into the first valuation model. Now typically it would be Graham's, but it isn't relevant for REITs. So we get the multiples valuation model, companies in a similar sector and size that we analyzed earlier. We have their P to AFFO multiple, average with that of Realty Income, and we do get an intrinsic value of this model today at just over $67. So we get our first undervaluation signal. Just bear in mind, we're not looking at any one of these models in isolation, and we will conclude shortly. We then have the dividend discount model with the yearly dividends over the period. As we can see, around 3.14%. Forward looking, we've gone pretty much around that at 3.25, and that gives us an intrinsic value of around $67, not far off the previous model, and again another undervaluation signal. We then continue to the DCF model. As we can see here, the free cash flow year on year. Average growth just over 20%. Forward looking, we have gone around 7%, still lower than analyst targets. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see here again a third and final undervaluation signal. So the intrinsic value in today's episode is just the three averages of these models, as we can see. The intrinsic value comes to $64.14. Don't forget you can click on the pinned comment below if you do want to grab a copy of this valuation model, run your own numbers through, or put in companies in your portfolio or those on your watch list. So we get to a margin of safety. Now we always start off with 10%, and remember we execute on this if it meets our three golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So if you believe that for Realty Income it is above to $58, then we keep going till it's near the current trading price. 15% MOS at $54.50, at 20%. It isn't quite there yet, so in today's episode for Realty Income, we do see between a 15 to 20% MOS level. In terms of Wall Street and their projections over the next 12 months, well, they believe upside of 16%. They have a price target of $61.38, so they do consider this to be a buy, as well as what we saw at the beginning of the episode with Seeking Alpha as well as Quant. As always though, do let me know your thoughts in the comments below. Does any of these news worry you in terms of the interest rates not looking likely to be cut in 2024, or with the store closures of Walgreens as well as the Dollar Tree, or maybe this is one where you're considering just holding for now? As always, if you enjoy the content, value is provided, smash that like button, hit that subscribe and bell button, let us know your thoughts, and as always, we'll see you all on the next one.